Thank you, Aaron. And hello, everyone, again. I'm really happy to be here. Today's presentation is going to be about the current market price structure. And it seems that I come on the show at the very interesting times. Last time I've been on the show, I was heavily short, and I was shorting the markets, with stocks like Nvidia and Apple. Nvidia worked out really well. Apple was not the greatest trade that I had, but still, directionally, that was a good call. And now today I'm coming in on what seems to be a short-term reversal call that we probably will be making by the close of this session. We definitely need to see how the intraday picture is going to unfold, how the daily close is going to show. But from the intensity of selling that we have from this morning, it seems like we are going into a reaction. I'm going to say that this is a short-term reaction. And usually when I talk to my students about some kind of market action as a reaction, we want to understand that we need to make a judgment as to the quality, the character of this reaction. Is it going to have more of a bullish quality or bearish quality? So we'll talk about this. We also will talk about the long-term picture. How do we view the whole market? And I'm just going to kind of like, spoil this poll question right away. I'm just going to say where I stand on this. I think that we are somewhere in the middle. We are not in the uptrend, but we are not in the downtrend either. I think that we are in the very prolonged consolidation in 2019 is probably going to have more of the trading range type of qualities market. So with that, let's go to the first chart and just grabbing the drawing tools. We're looking at the long-term picture of S&P 500, and we're looking at S&P 500 from the lows of 2009. And usually when I put one chart with one scale or another, usually students go and ask me the question, well, you put the logarithmic. Well, what about the arithmetic? You put the arithmetic. What about the logarithmic? So here we go right away to erase all of the questions from your minds, both scales in front of you. So look at the trend. What do you see? What is the long-term trend? It's still up. No matter how you're going to view it, no matter what your definition of the long-term trend, we still have higher highs, higher lows. The price is contained within a long-term channel on both scales. So we do have spots where we have short-term oversold conditions. Those are usually cyclical lows within the context of a much larger secular uptrend. Now, there is a lot of talk in the media about, well, it's been a while. It's kind of like the uptrend is going on the year number 10. Well, think about the runs that we have had since the lows of 1982 into the highs of 2000. That's 18 years. How's that possible? Well, there are markets like this. There are secular uptrend markets that are going to have very significant cyclical lows like 87, 89, 91, 94, 97, 98 before we actually hit the top. And those could be quite significant. Those could be 15, 20% within the structure of the overall big market. So that is the first question that we want to answer today. The second question is, let's say that we're kind of like exploring a bullish scenario. How would the price structure unfold from this point on? What we're kind of claiming today that maybe there is a daily reversal that we are anticipating by the end of the close of today. And maybe that will produce what Tom has mentioned, a technical rally, which I really like as a definition. So do we have enough space within the structure of the current up channel to have that type of technical reaction? Well, we certainly do, especially if this is a higher low. Then it doesn't really need to be, violating the support that much. And we also know that we could be in some kind of oversold condition going even with that reaction. So until it actually decisively breaks the long-term trend, tries to rally on a weaker rally and then goes down, confirms that, move to the downside, I think the long-term picture is still under question. Meanwhile, short-term, and I'm going to show you on the intraday, yes, we would be expecting some kind of reaction. And as Aaron was saying, like, this anticipation that the reaction is going to happen was pulling a lot of traders to put on the short positions. And I'm going to show you one of the analogs that we used in our classes to address this rally. One other point here that I want to make on this particular chart is, if we are in some kind of consolidation, what would be the duration of this consolidation? So looking at the analogs of this same secular uptrend and looking at where cyclical lows in the oversold conditions were formed, and looking at the duration of those formations, we kind of see that sometimes it takes some time to take the new high. And during these times, we are going to have pockets of high volatility. Well, don't we see the same picture here? Kind of we do. So it all depends on what kind of reaction we're going to have. Is it going to be more of the bearish market type of reaction, where we're going to create a new lower low, or is it going to be a bullish type of reaction where a new higher low is going to be created relative to the low in December, and from there we might rebound again? All right, let's go to the next one, and let's check out the breadth and the momentum. And there is a lot of talk about that too, and I think it's a correct conversation to have. Is the rally that we're having currently, that we're in currently, does it have enough momentum? Is it healthy enough? Is the overall market participating in these rallies? And to look at the analogs that preceded this type of rally, this type of action, we have to go to 2016, and we would see that on the rate of change, we're having momentum kickoffs where institutional buyers are extremely active, and they are initiating their positions, accumulating the stock for the next run up. In 2011, the same thing happens. Momentum kickoff. This is where, again, institutional buying is very aggressive. They are coming into the position in anticipation of a big move. Well, on the momentum side, we definitely see that we're there. We have overcome intermediate highs. It suggests that institutions are buying, and the questions here is why they are buying. Why we were thinking that this is a bear market, and yet they find value at this extreme short-term oversold condition. Well, maybe they're, again, concentrating on the economy, concentrating on earnings. This is what's most important to them. In my conversations with institutional managers, and that is the theme that comes up constantly. Any bearish arguments that I have for them is being countered by, look at the economy, look at where we are. We are not necessarily growing at the same rate as last year, but it's still a relatively high level for the U.S. economy. Plus, U.S. is just definitely outperforming a lot of other economies. So the breadth and the health of the market on this rally, and I think Aaron has mentioned this, is pretty good. All right, well, let's look at the analogs. This is the analog that we started using somewhere here after the test. This was one of the analogs. We were looking at the bearish analog of 2000, 2007, and that failed. Once the analog fails, you have to find something else. So there are two analogs that I found for our students. One of them is actually Tesla. Tesla in 2014, 15, 16 has been in a very interesting position. It almost seems like the long-term growth of the company was on the table. It was there. Everybody knew that the company has a lot of potential, but yet short-term problems created after a reaccumulation texture environment where we have diminishing downspread, we have diminishing volatility that produced the rally into the upthrust situation. But then after that, we have distributional qualities where supply is coming in, where the result to the downside is expanding, and that led to a short-term downturn that turned out to be a shakeout. Does it look familiar with the markets that we had since the beginning of 2018, where we had that type of reaccumulation type of texture with absorption elements, then short-term distribution, and then a shakeout? What happened afterwards in Tesla? Well, institutions are seeing this as an extreme value. Also, there is a lot of liquidity at the bottom of this shakeout, and they are buyers. They are aggressive buyers just based on the long-term picture. So in a way, that's kind of like how I view the U.S. economy. It's just long-term, it still has some potential. So I think institutions are not easily giving up on their positions. Now, this analog is very similar to what we've experienced in the Dow Jones Industrials in the 60s and 70s. Look into the Nixon shakeout, the Watergate, and then the rally that we had out of that. This is a very aggressive rally and very sharp rally. By the way, Tesla, in 2 months, rallied to the resistance. And that's a very short period of time to travel so much in such a short period of time. So looking at what we have in the current structure, a shakeout that leads to a smaller trading range that has all of those reaccumulation attributes and attributes of absorption. An upthrust, something what we've experienced in both the Dow Jones Industrial and Tesla. And then a distributional pattern that leads us to a short-term downturn that is possible shakeout action. Why do we talk about the shakeout? Well, if we would have an automatic rally, automatic response out of the climactic condition, and then the price would stay here, that would look more like 2007, 2000 type of market where the rally is so weak and it cannot travel back into the trading range. This is a different animal. This is a different type of rally. It's very strong. It came back into the trading range. It came back to about 1/2 of the height of the range. So that tells us that a bearish scenario, even if it's going to unfold, it's going to have a different structure. All right, let's go to the next one. Well, let's look at the way how the Tesla analog acted on the intraday level. And I want to point your attention first to the volume signature that suggests that the volume increase suggests institutional buying at this extreme oversold condition. And look at the rally. It doesn't have big reactions. All of the reactions are kind of the same quality, muted, and only when we go into the first overbought, overthrown condition, we produce some kind of change of character that produces the reaction of a larger magnitude. Yet, we're still going up after the consolidation, and this is the area where we start developing some kind of volatility. We see this from the price action, we see this from the volume signature. So usually that would indicate institutional selling. So we had the buying at the bottom, we have the selling at the top, and this is how this pattern has failed to continue to the upside. And this is exactly what I'm expecting to happen with the markets. So initially we have the volume increase around the lows, around the Christmas lows, and that suggests that there is some institutional buying. There is a lot of momentum in the first two rallies, so that also suggests buying by institutions. And then the rest is just a continuation of this rally. Well, what recently has been happening on the intraday picture is that the latest rally out of this consolidation, and look how everything kind of repeats in this analog with the overbought condition and then a non-trending environment, the momentum started to go down. So that was a precursor for the potential reaction. So we have today a slightly increased volatility. I like how the supply is coming in. So this means that there is some more institutional selling that we see in this. And obviously that comes after the slowdown and the momentum. So that suggests the reaction. That suggests kind of like the timing also for the reaction. All right, let's look at the next chart. So here, the questions that we need to address: what is the current bias and what is the current Wyckoff labeling? So let's start with the very long-term bias. The long-term bias, as I have shown you guys, is still up. I don't think that anybody can convince me since the lows of 2009 that we are not in the uptrend. We're still in that uptrend. The intermediate bias is a trading range. And I think if there is anything that you can take from this presentation, I would like you to take this. I would like you to think about how the structure unfolds here. I mean, we are obviously staying within the structure, within the confines of the support and the resistance, and we could have different lines here. We could extend this trading range, the height of the trading range, and we definitely see how we were in the extreme oversold, extreme value proposition spot. And we came back. So we are still in this formation, in this larger formation. So that gives me an idea that intermediate bias is just a consolidation. And then the short-term bias, and I was preparing this presentation yesterday, so the short-term bias is to the upside. That's a predominant short-term bias even for now. But today, as I mentioned, and it's just so funny how I come up on the show and something like this happens all the time. I think that we are actually very vulnerable to violate the trend line today. If we're going to close below it, we probably going to have the reassessment or institutional reassessment of the short-term picture, and that should produce some kind of short-term capitulation. This capitulation could look like a big bar to the downside. We would call this a change of character bar. What are we changing? We're changing one environment, an uptrending environment, to the next environment, which could be just either a larger consolidation with the short-term bias to the downside. So I'm going to kind of like maybe even cross the uptrend here, and I'm just going to say that we maybe are going today into the short-term downtrend environment. And that would be healthy, by the way, in any environment, in any structure that we would be. It would be healthy in the trading range environment, in the bullish environment, and in the bearish environment as well. I put some targets here that at this point I'm doubtful that we're going to reach. Also, please note that we came back to the institutional value zone. That value zone was created by the buying on the selling climax into the lows of February, absorption around April, May, June, and then attempts to stop the downtrend in the same place. So this extreme oversold condition on the terminal shakeout produced that value for institutions where they just were starting buying, and look where it stops. Look where it's going to react, if it's going to react here. Again, they brought it to the value zone and they're saying this is where it should be. But as always, the short-term moves produce a change in sentiment. So from extreme oversold condition, we're going to the overbought condition, and that suggests a reaction. So we kind of bound to have the reaction, and the biggest thing is to understand what kind of reaction we're going to have. Are we going to have a more shallow reaction, which is still a bullish scenario with the higher test? We are just basically expecting a test of the previous low. Or would we have more of a lower test, more oversold, short-term oversold? And there are still spots where you can go and still could have a consolidating and even bullish environment after this. So that's why it's so important to understand the quality and the character of the next reaction. Another analog that I like at this point of time is the analog with Apple. Look at the distributional top that we have in the S&P 500, just recent top, and we're using the reversal, three-box reversal traditional scaling. The same happened with Apple before it had a big shakeout. And look how this catapult wall down is so similar to what Apple has experienced. Came to the lows, came to the previous lows, and then very sharply is going up. Very sharply is going up. So there is some institutional buying off this low. So one of the scenarios which is still bullish, this was 2016 trading range for Apple, where Apple consolidated and then went up. So in this scenario, the price came back to the lows of the climactic action and retested those lows. So, but it went down in a different way. It was having some kind of capitulation, and then after that, every next down thrust was diminishing, suggesting that there is some buying on the way down, absorption on the way down. So that's why I'm still thinking, even if this scenario unfolds with the market, we're probably going to be still in some kind of trading range for 2019. So that poll question that I had for you guys, I'm seeing that a lot of you are with me. You kind of saying that we're going to be in the middle. We're going to be between the highs of September and the lows of December, which I actually agree on. Okay, so how would a bearish scenario unfold for those of you who are bears? So imagine if this reaction is quite significant, and the character, and this is going to be extremely important, and the character of this has a lot of bearish characteristics, and the price goes actually to the lows, and then after that has no ability to come back to the higher structure and creating lower highs. That would be a signal to me that there is a deterioration of the price structure, and especially if it happens on increased institutional supply and reemergence of volatility. And by the way, this reaction, that's going to come, it's going to have some volatility, because a lot of people are going to be thinking and emotionally remembering the latest decline that we had from September to December. They're still going to be vulnerable, to act on that. Having said this, I'm telling my students that you gotta look on both sides right now. You gotta look on the bullish side and you gotta look on the bearish side. And usually, I would say this only when I'm expecting some kind of trading range environment. And also, I want you to be extremely selective in your time frame. Whether you're initiating a very long-term investment type of the position, you have to be aware of all of the elements that should go into that selection. Or you're swing trading, then I would prefer you to look at selection on both sides, especially in this type of market. So how would the bullish scenario path would unfold? We definitely would go into the overbought condition. We would experience some kind of change of character, maybe a reaction, and then some kind of consolidation. That would be the bullish path. So we could spend a quite considerable time here in 2019. So my performance expectation for the market is in the single digits, but still profitable. It could be, something ridiculous as like 3, 4, 5%, something like that, or even close to the break even. But I'm still expecting that volatility is going to go down, and we're going to have some kind of consolidating action. All right. So then the last bonus question, number 11, and I'm not sure how much time I have, but I want to go and show you some of the stocks that I'm looking currently at, and I'm gonna go really fast. Do you guys see my screen? This should be.
Yeah, we got you.
Yep. Okay, great. So I was looking yesterday at the media agencies at our Wyckoff market discussion class that I conduct with Bruce. And for those of you who would like more information on this, come to our website, wyckoffanalytics.com, check it out, request a free access to, a session. I'll gladly do this for you. And just, it's always a constantly discussion about the market. So in looking at this yesterday, we were talking about a consolidation. And then, what has happened yesterday and what's happening today on the increase in supply signature with the deterioration and divergence that Tom was mentioning. Look at the price, higher high, and then lower high, and the momentum is giving us a different reading. So that type of divergence that I also don't like. And the way how it creates the lower high and then just pushes everything down is very peculiar. So what kind of stocks and you would be looking for in this type of sector, in this type of group? Well, the ones that climacted, we're trying to go up on multiple attempts where you have increasing effort to the upside, and yet it produces just an attempt to upthrust. Very bullish sign, looking visibly bullish bar, but yet nothing happens after this. So this is a failure. Another sign of weakness into the commitment below the support, and then inability of the price to come back to the resistance. And then on the increase in supply, we are dropping down. So let me just quickly go through this, and maybe I'm not going to use my my pen here. Fixed line telecommunications in the downtrend. So you want to find the stocks that are going to be in this group that are going to exhibit the same type of the characteristics like AT&T, and look at how we are stepping down with each of the consolidation. Look at the moving average. I'm using different moving averages here. 252 is a year moving average. 63 is 2 quarters. That is just an institutional reference. And 21 is the monthly moving average. And again, on the rate of change, we have the new high, and yet the price is showing a lower high. Divergence, not something that I like. Investment services, think about the market structure for the whole 2018. What kind of returns investment services could provide? Not a lot, so that's why we have lower highs, lower lows, oversold condition that produced a technical rally, but look at where it comes to. It comes to the resistance that acted before as the support. So also not that attractive. How would we be trading something like this? Well, we want to find stocks that are already in the downtrend in this group, that are exhibiting short-term weakness, and something like E-Trade with the lower highs, lower lows, suggesting that at least we're going to retest 40. Maybe we're going to go to 36 and be still in this kind of like expanding downtrend. Intercontinental exchange, what seems to be a leadership. And this is such one of my favorite patterns. Leadership distribution that has reaccumulation characteristics going into the upthrust with the change of character and then an ability to rally. And look how nicely this shorter term upthrust unfolding. And today it's just a lot of selling. So some of these stocks that were leaders are becoming laggards. Look at another one in the same group, CBOE. Well, that one is probably one of my favorite charts right now as a short position. We cannot lift here after we've created multiple lower highs and lower lows. This is an element of a distribution. This is an element of the poor demand. And look at the momentum signature. Lower high again, and the momentum is not that strong. This is such a great candidate, to look for a short. CME, Chicago Mercantile Exchange, another leadership stock in the same group. But yet, as the market was rallying, what are we doing here off the December lows? Nothing. And these are the stocks that we would want to look for our short positions. Long positions. I really like Aaron's idea about utilities as a defensive and as also, stocks that might appreciate in this environment. If we are going to have a bear market or continuation of the bear market, these are great. If we are going to have some kind of volatility, these are great. I'm looking at the water as a group in general. In there, look at some of the stocks. American Water Works, just an uptrend. December shakeout is within the structure of the uptrend, and yet it just recovers so quickly. Look at Aqua America, kind of the same pattern, maybe a little bit weaker, but still ability to stop the downtrend both in October and in December, and then coming back into above the short-term resistance. Another one that is conventional electricity group, and kind of the same pattern because of the same theme, right? Flight to safety, flight to quality, and in there something like Axel Energy. Already overcoming the long-term resistance, creating a commitment above that resistance, reacting within the market in a shakeout type of manner, creating institutional volume behind that reaction and then coming back really quickly above that resistance. That's very bullish. Another stock in the electricity group, well, this one has been a leader for quite some time. And these are the ones that on this reaction, and this is very important, I'm not suggesting to buy here. This is an overbought condition. I'm suggesting for you to look at this stock during the next reaction and to define what kind of quality of the reaction we're going to have for a leadership stock like this. And then into more regular themes. Let's look at some of the themes that, and I'm going to try to be quick, that could be potential longs after this reaction. Well, when I look for longs right now, one of my requirements is the rally overcoming the previous point of selling that we have had in the market. And Aerospace is one of those groups that did exactly that. Look at the momentum. It's a significant run. Look at the volume confirmation. Volume increases. Institutions are coming in. They are eager to get into this position. Yes, we are vulnerable for the short-term reaction, but these are the stocks that I'm putting on my watch list for the next potential move up. Another stock, the stock now in this group, what would be the stock, right? So Boeing has all of the characteristics of comparative and relative outperformance. It's still in the long-term uptrend. Look at the long-term moving average. Look at the momentum that it has created on this rally, and more importantly, above the market, above the group, it has created the new higher high. And that suggests strength, that suggests leadership, that suggests that institutions are not willing to sell at this point, and they're willing to hold on to the supply of the stock. So we are waiting for some kind of backing up action, some kind of reaction that is going to be much more favorable than the reaction of the market or the group.
Roman,
yeah.
I know you've got a couple questions. I want to make sure those questions in the room. But before we get into those, I was wondering because you got TDG. This is actually the stock I was going to ask you about, which is pretty funny.
White twitching.
Yeah, but we talked about the aerospace group yesterday on the show.
Oh, great.
This was one of the areas that I thought really looked good within the industrials.
Yes, I agree.
I think it's pretty cool that you're kind of going in through the same group and looking at it from a Wyckofian perspective and seeing some of the same things. But TDG was the one I was going to ask you about to maybe take a look at. And then we have a question or two from viewers before we get into the poll.
Excellent. What was the question about TDG?
Well, I was just wondering if this was, given, your review of it from a Wyckofian perspective,
right?
This one as good or maybe even better than Boeing in the aerospace?
I like both of them. I like Boeing more, kind of like on the longer side of the position because the causality in Boeing has been quite significant. So when we look at Boeing, we are recognizing that the trading range has been developing for almost a year. So that's a sizable cause for us to produce a sizable swing to the upside. So I would be really anxious to see what kind of reaction we're going to see here in Boeing. It's one of my favorite stocks right now. So is Digm. Why? And we actually had a session with Mary Ellen. We invited her to our Wyckoff market discussion. She was the one who brought up this stock. And in preparation for that session, we were discussing this, and I'm like, this is one of my favorite patterns. What is so great about this pattern? Well, look at the trend. We're judging the trend by the moving average, long-term moving average. It's up. Look at the February lows, March lows. They did not produce a significant reaction below the previous support. More importantly, the leadership has still been intact on the rally after that. We're significantly outperforming the market with the move to the upside. And then more recently, October low, December low, they are more subtle than the market. They are not creating lower lows. So that's a very good pattern. And then we have at the end of it, an absorption where supply has been diminished so much throughout this whole structure. So Tom, this was this kind of like my pattern for swing trading, for short-term swing trading, and that just was a really good candidate.
Well, now, I mean, if you're looking at this chart now, obviously it's made a huge move. Would you even begin to initiate a position at this point, or would you have to see a little bit of a move back?
There is no reason to do this right now, right? For two reasons. Why? Why? Well, we are in the short-term overbought condition here. That's a just a reaction. Plus, and this is what students forget about, the market. Think about what the market is doing. The market has so much force, so much gravity, that it basically moves everything with it. Just think about like big celestial, bodies, out there. They have so much gravity that they, we kind of bound to their movement. So the market, I look at the market the same way. So these two components suggest that you just have to wait.
Okay, cool. Very good. All right, before we pull up the poll, there's one question that came in and asked, how can you tell, you were circling volume and saying institutional buying and selling. How can you tell that it's institutionals?
Sure. First of all, for this type of questions, come to our website, check out our flagship course, which is Wyckoff Trading course. I teach 15 sessions in that course, and we go through all of the details, nuances of the analysis on institutional buying and selling. In this example, very quickly, we look at the volume signature and we look at what the price has done. The price has stopped going down on the increased volume signature. So we are suspecting that supply has increased at this spot, but so has demand. Why demand has increased? Well, because of the stopping action. So somebody had to come in and to absorb the supply that was available. Well, who would do that? Well, only institutions can do that at the point of fear. Weak hands will be capitulating at this point. Weak hands will be giving up on their positions at this point. That's the nature of their behavior. Institutions are going to seek value. In where? They're going to seek value in the leadership stock, especially during the market's reactionary lows. So therefore, this type of signature is of institutional type. And what do they do throughout this whole range? They are buying. They are buying. They are buying. They are buying at the low. All of these lows are showing us that institutions are buying. They are buying less throughout this whole trading structure to the point where supply has been so exhausted and where they don't have to buy. And usually after that, there is some kind of anticipation of the event that was earnings. And on earnings, you're going to have more institutions and more participants changing the sentiment and coming into the position, and that would produce that momentum that we see on the earnings day. Tom?
Yep, excellent. Another point maybe to make too is TransDigm. When it fell back in December, it did not break below the prior low, even though the S&P 500 broke by a mile, and so did the Aerospace index as well. So
absolutely
good relative strength there for sure. All right, we're going to bring the poll up, and while the poll is up, there was one other question, and the question was, Ramon, since you expect single-digit gains for 2019, do you think we've already hit the high for the year?
I would probably be inclined to think this way, just because I think that the bearish sentiment is still extremely strong. So this reaction is going to kind of like have this sentiment of, oh my gosh, see what's going to happen, and that's going to produce a lot of anxiety with institutional managers, and some of them are going to, trim their risk, and they're going to start selling again. So that's going to produce some kind of short-term volatility, and that will establish the high as kind of like an intermediate short-term high. I would not be expecting that we would, go up above this high right away. So there's going to be some time that we're going to consolidate. So hopefully we're going to consolidate actually into September, October, November lows. And then out of that cyclical seasonal low, I'm expecting that there's going to be some kind of rally. I'm not sure if we're going to overcome in such a short period of time, in let's say November, December, the high. It's possible, but that's kind of like the scenario that I'm looking at. So maybe like 60% of the consolidation, and then with the possibility out of the seasonal low for a good rally.
Okay. All right, well, here is the result of the poll, and you can see 51% are saying that we will finish the year somewhere between the September 2018 high and the December 2018 low. I am going to go with the second choice. I think we go back and break out again later in the year. I think it'll be in the fourth quarter. I agree with you. I think we're going to consolidate. Typically, the fourth quarter is very bullish. I think by the end of the year, we're going to break out above the September high. Just my call. What do you think, Aaron?
You know, I was looking at it. You know, I'm bear market mode, so I considered the below the 2018 low. But my sense is that we're going to go through this decline, and the bear markets usually don't last as long as bull markets do. So I think we could certainly get back in above that September high by the end of the year. I don't think we're going to see that for a while, but we'll see.
Okay, cool. Well, Roman, it was a pleasure to have you on here again. Really appreciate your take on the market. I think a lot of it makes perfect sense. I think our viewers probably would agree. And we look forward to having you back on the show soon and take another look at the market, see where we are in a couple months.
Thank you so much. Invite me on the next reaction, please.
Sounds good.
Bye-bye.
Thanks so much for stopping by.
With 3 unique service levels and multiple data plans to choose from, StockCharts.com makes it easy to customize your account to best match your specific needs. In this video, we'll help you explore all the benefits of your membership by explaining our service levels, data plans, and pricing. Let's see how it works. To start, you'll want to choose from one of our 3 service levels: Basic, Extra, or Pro. Each service level represents a collection of features and options bundled together. If you're new to StockCharts, our basic service level is a great place to start. At $14.95 per month, Basic will allow you to create larger, more powerful charts and save them to your account. Next up is our Extra service level, the most popular choice among StockCharts users. At $24.95 per month, it includes all the features of our basic level, plus more saved chart storage and the ability to create custom scans and alerts. If you want it all, our Pro service level is for you. At only $39.95 per month, Pro includes even more storage for your saved charts, custom scans and alerts, as well as faster auto refresh, historical data, and much more. For all service levels, you can choose to subscribe on either a monthly or an annual basis. Our monthly renewal option is similar to most other web-based subscription services. You pay for 1 month of service at a time, and your account will simply renew automatically each month. With our annual renewal option, you prepay for 12 months of service and we'll give you the 13th month for free. If at any point you'd like to change your service level or renewal preferences, you can always do so from the Your Account page. Now that you've chosen a service level, let's find a data plan that works best for you. Regardless of service level, all StockCharts accounts come standard with our free data plan, which uses BAT's real-time data for the US and delayed data for all other markets. However, if you want to enhance your StockCharts experience even more, you can customize your account by adding official real-time data plans for one or more of the stock exchanges we support. Similar to exchange fees, prices for each plan vary, as they reflect the fees charged by the exchanges for your use of the real-time data. We want to make sure you have the data that's right for you, so our data plans are flexible and can be added or removed at any time. Keep in mind that all real-time data plans are billed separately from your service level subscription and always on a monthly basis. Unless removed from your account, data plans renew automatically at the end of each billing month. If you do choose to remove a plan, the change will take effect at the end of the month. All data plan charges are non-refundable. To explore all our data plans and update your preferences, visit the Your Account page. StockCharts.com gives you the charting tools and resources you need to invest smarter. And now with the flexibility to customize your service level, renewal cycle, and data plans, we make it easy to find the account options that are just right for you. Take control of your investing in just a few simple clicks with StockCharts.com, simply the web's best financial charts.
Here's how to put a simple line on your chart without using the annotation tool. Let's say we want a line in here at 47.50. You can just drop down here into the overlays, pick horizontal line, add the price point, 47.5, and we're going to use a red line. We're going to make it solid and thick and hit update, and that blasts it into the middle of your chart.